Okay, let's talk about Walgreens Boots, WBA. The ticker is WBA. Interesting, if you go a few years back, 3 years, the ticker was different. After its merge with other company, it's got a new ticker, WBA. That's how it looks like. And Walgreens Boots has three segments in their company. So it's Retail Pharmacy USA, Retail Pharmacy International, and Pharmaceutical Wholesale. So they have both areas, retail and wholesale, and that's why this company is pretty strong, and it looks like one of the biggest in US area and in value line at least universe. Now it has more than 8,200 drugstores, worksite facilities, home care facilities, even mail service facilities, and specialty pharmacies. 66% of their sales contributed by pharmacies. And another good thing about why I wanted to show you, it's 21.1% of common stock is owned by officers and directors. And we discussed it quite a lot of times that officers and directors, when they own such a huge amount of share, it means that they're going to take care about profitability of the business itself, not just to show profit in order to get their bonuses, but actually to create a shareholder profit, okay, which is really, really important. So the company 90 billion in capitalization. So it means that these guys, they own just below maybe about 18 billions of dollars in stock, which is fantastic. Okay. Now that's kind of product it has in their area. So it's beauty, vitamins, household, seasonal, personal care, etc., etc. So it's quite a huge range of products which they supply. I'm not going to go through details, but you can go online and have a look at this more precisely. Okay, let's have a look at the industry. You can see this report. And when you analyze, if you look at different companies, okay, you will see that majority of them, they dropped down in price during 2015, or at least were flat, okay? And you can see that WBA, Walgreens, it's one of the biggest companies in this area, okay? And for example, another company which I like advise you to have a look and research maybe precisely, because it's interesting from this point of view, it's Express Scripts. So the ticker is ESRX. Yeah, this company has some issues right now. So, but if you want to analyze it, of course, you can do that as well. Okay. Now, and that's you can see the safety ranks here, and also you can see the timeliness rank. Now, timeliness rank, if you remember, the timeliness rank, it shows you how company going to perform from price perspective, like grow in price within the next 12 months. And we can see that Walgreens is going to go as average. 3 is average, 1 is the best, second is second best, 4 and 5 is the worst kind of already. So, and again, remember that it's value lines opinion. Okay. Now, if you go through this, you will see that WBA is planning to buy Walgreens, trying to buy other company, and this company worth is $17 billion. At the moment, they are waiting for government approval, because if WBA buys this company, it becomes one of the biggest in US, and they're afraid it becomes like monopoly in this area, and it can set any prices which they want. And the government always very careful with this type of situation. So that's why they're reviewing at the moment this deal, and it can be approved, but it might be not approved at the same time. Okay. Now let's go through value line report. First of all, we see the price here. It's $84. Right now, if you go on the market, it would be only $81.55. PE is 17. And relative PE is 89. So it means that it's below average. We see that company pays dividends, 1.8% in dividends. Okay, and the interesting thing, like, let's have a look first per share, and then we'll look like financial activity per company. So that's what we can see. So if we look for the last 16 years, we will see that the company constantly was increasing their sales level. So it's $20.98, 24, 27, and only two periods in their lifetime, or even I think in sales level it's only one time. Where is that? Here in 2011, when the sales went from $81 to $75. So it's $6, which is less than 10% in sales. Okay, drop down. If you look at the profitability and earnings on that year, it went down 11 cents, which is less than 5%. And also the drop in earnings, so that's the third line, earnings per share. We can see that within 16 years period, the company dropped their earnings only two times. One in 2008 by 5%, and in 2011 less than 5%. So it shows us it's pretty stable company. Like I believe that if there is economical crisis and you get sick, you're not going to sit at home and die, right? You're still going to go and spend any money you have for buying like medical prescription in order to pay for medicine for your children, for your wife, for yourself, and etc., etc., etc. So that's why this type of business, if you're investor, is pretty stable. But again, despite the profit and the sales level was growing all the way up, look at the price. That's the graph here. So we can see that the price here was $51, and despite the drop in earnings only 5%, the price went to $20. So it's 2.5 times. Why? Because the because the multiples here was too high, and that's how we can see it. If you go to average annual price earning ratio, the price earning ratio was 46 times here, 27 times, 36 times. So it means that people were paying 36 times higher than the earnings of their company. So, and we discussed that if PE is equal, let's say for $1, and company is on a sale for $10, it means that you have to wait 10 years in order to recover, like, I mean, to get your money back. In this particular case, people were happy to pay and wait for 46 years. They believe that the company is going to grow, and that's why they were overpaying for this particular company. Okay, and imagine if you purchased it at $51 in 2006, and at the moment it's only $81, so you will have about what? About 60% profit, which within 10 years time. So quite a lot. So that's why it's very important to buy when the market is low and using the opportunities like represented in 2008. Okay, let's have a look at other parameters. Book value. Book value is $27. So it's 3 times practically less than current share price. Okay, dividends. It pays constant dividends, and they're constantly growing, which is pretty good for us. Okay, we can see that the earnings growing in the last year, and they are planning to grow. Okay, and if you go to financials of the whole company, we can see that sales level was growing up all the time, except 2 years as discussed above. Now, interesting here, if you look at common shares outstanding, because remember, for us, it's important to know how many shares in the market, because it represents your part of ownership. And we can see that here, the company was decreasing them. So it was 1,010, then increasing, like kind of flat down. And we can see it was dropping down. So in this area, it was buying shares. So when the market was low, they were buying quite significant amount of shares. And we can see that only in the last couple of years, they increased the amount of their shares. So from 946 millions to nearly like 1,089 million. And the reason for that mostly, and we are going to look at this now, look at book value jump. So they increased the amount of shares, but at the same time, the book value per share increased practically what, nearly 30%. What do you think happened here? What's your opinion? Can you write it down? Alexei is correct. Peter is right as well. So they purchased other company. So that's why they did it. So first of all, they increased the amount of shares, some cash, right, and purchased a company. And they, despite that, your part of the business, it's increased quite a lot. And you can see that profitability jumped here practically 30% from 433 to 535. Okay, and that's why when we look at their previous acquisitions, and if you look at the history, previous history, you will see that they're doing it very nice, like properly, and it gives us certain kind of confidence in like upcoming acquisition. They are planning to buy this new company. So, and if we see that they've done it properly before, most likely they're going to do it good as well. I remember when I followed Hewlett Packard, and for several years I could see that every acquisition they make, it has some troubles. Okay, and of course when I find out that they're going to do another acquisition, they just sold it off and didn't have those shares at all, because when you see in the history that company constantly mess up with their acquisition, so try to avoid it as well. In this case, it's vice versa. They're doing it pretty well, so it's give us certain confidence in what is going to happen. Now, the interesting thing what I've noticed here when I analyzed it, look the amount of stores. It was growing. 5,461 and etc. growing. Last year it was that's the jump, right? So from 8,300 to 1,300. Okay, so which is pretty good. So they acquired about what, 3,002, nearly 5,000 stores they acquired here. Okay, but look at what they are planning to do. They are planning to reduce it to 10,000. So in 5 years, so they're going to close some stores. Why they're doing it, I'm not sure. Are they going to do some online storing? Not sure, but we definitely can see that they are planning to reduce the amount of stores which they have, which may be not that good stuff. It depends how they're going to do it and the reason why. If they're closing not profitable stores, it will be good for us. But if they're just closing it for any other reason, it might reduce the sales level and especially profitability. Okay, so we have to look at this in more detail. Now, another thing which is very important to see, it's margin. And we can see that gross margin is pretty nice, like 30%. But when you look at net profit margin, it's only like in a range of 4%, which is really low. Remember, if somebody remember Guild, what kind of net profit margin was at Guild? Remember that? If you remember, just you can write it down, and you can see that in some companies, like net profit margin is huge. Okay, and Guild, if you don't remember, it's around 50% net profit margin, and 70% it's like gross margin, which is like very, very high compared with this type of industry. So it means that they practically don't have a room for discounts. Okay, because if they give discounts, so they practically eat all their profit. So they're working in a very, very tight area. Okay, and it's kind of not that good. Warren Buffett trying to find companies which at least have 10% in net profit margin, or even 20, you know, so that would be the best area. Okay, so the next part is debt. We can see that they have about $19 billion in debt, total debt, and the company is $91 billion, $92 billion in capitalization. Now, it means that the debt is around like 20%, maybe a bit more than 20%. And it's kind of, for some companies, high. For this company, if we look what kind of level of cash, also we're going to look at the cash situation. We can see that current assets, 25.8 billion. Current liabilities, 7 billion. So it means that they have about 8.8 billion in cash. And we look at this, they actually have 9.8 billion in cash. So half of this debt they can pay straight away and reduce it. So it shows us this this company has a really strong financial and cash position. Another thing which we can have a look at is net profit in like real value. We can see that annual profit is $5 billion. So it means that they can cover this debt within 4 years. And we can see that within 5 years, they have to pay on the 7.7 million of like 7.7 billion of debt. So it means that the rest of that is above 5 years. And they can cover it within 1.5 years of earnings. So this company is pretty stable. And we don't have, actually, I'm going to answer one of the questions a bit later about other company, and I will pay attention to the debt level. So here we can see that company can make and cover this debt from earnings, 5-year debt within 1.5 year, and the total debt within 4 years of earnings. But if you notice how the cash position increased within last 3 years, from 2014, it was 2.6 billion, then 3 billion, and now 9.8 billion. And I presume you understand the reason why they have so much cash, and they are planning to acquire this company and pay for the 17 billions. How they're going to do it, I'm not sure. Are they going to pay half of it and pay like nearly 9 billion in cash, and maybe then they will borrow money to purchase it, or maybe they issue more shares and to purchase this company? I'm not sure. That's a decision of directors. Now, these two companies, they already agreed for the purchase, and at the moment they are waiting only for government approval. If government approves it, they will go ahead and do that. Okay, but we don't know that. Okay, so that's the thing. Now, if we look at growth rate, we can see that within last 10 years, company was growing 8%, 8.5% in sales, and last 5 years it's kind of growing slower. Whereas earnings, they about the same. Yes, 1% lower, but 9 to 8% is kind of about the same. But company is planning to grow faster. Okay, it shows that they're going to grow in sales 11% and 13% in earnings, which when I see something like that, I see that within the last 10 years, the growth was smaller. The question is, why do you think you're going to be growing faster from now if you couldn't do it before? Right, so I always doubt. If I could see that the company was growing 20% before and now they're telling me that they're going to grow 13, I will believe that because it's kind of slower growth. But when the company is telling me that they're going to grow faster and they never did on the same level, I kind of suspicious, and I presume it's kind of a good thing to be like that. Okay, so that's about the growth rate. And if we go back to previous slide, you can see that value line believes that the company will achieve the level of $100 to $140 level within the next 3 to 5 years. So which represents growth, total growth from 20 to 65%, or 6 to 15% growth annually. Okay. Now, of course, if you buy it cheaper, you can increase your growth rate. If you buy it whenever you buy it, you actually reduce your growth rate. Okay, so you have to be really careful on that. And here you can read about this company, and we can see that what company they're going to acquire. This is that's what they're buying, Rite Aid shareholders, right? So good thing when you see the acquisition and you want to predict how much they're going to make, analyze Rite Aid as well. Look at their value line, if they have value line, and see how much they make money. So, and it means that on the top of what company is making right now, they're going to add this profitability in majority of cases, not always, but if, for example, they buy another 1,000 shares, another 1,000 of pharmacists, they might increase and get the same profit as they had before, because we looked at this, that if the pharmacy exists, they're going to have a consistent sales level and earnings level as well. Okay, we can see that quarterly, that company is stable, didn't have any loss ever, like at least what we can see here, so which is pretty good for us. Another thing which I always pay attention is this bottom corner. It's good that company is A+ strength, financial strength, but another thing I always pay attention is earnings predictability. Okay, 85%. So it means that company 85 times right out of 100 of their predictions, which is pretty good. I remember we looked at some retail companies, and some of them they have only 10% prediction, which is means that they write only 10 times out of 100. This company gives certain security, and actually this earning predictability could work both ways. So they might tell you they make $1, they make $1.20. It's reduced the score as well. Okay, so it's actually not only when they make less money than they promise, it's when they make more money than they promise as well. So that's a statistical point. Another thing is 80% growth persistence. I believe that they lost 20% within last year because of this drop from $90 to 71. And if we look probably at their report last year, maybe this score would be higher. And I'm just curious, maybe I'll have a look at myself and see what kind of scoring was there. So it's kind of pretty good score if you compare with other companies in this universe. Okay, so when you analyze. All right, so let's have a look. If we go to analyze it using TACN spreadsheet, that's what we're going to get. When we analyze company for quality, we get 40 points, which gives us this higher score. So if we have 40 points and above, it gives 4 points for maximum, like TAC guide 4. And if it's above 4, it's ideal company from quality point of view. Okay, and we look at value line, you can see it yourself that it's consistent growth, right? Profitable company, and etc. etc. So it shows us that it's quite good quality. I would put this company on the same scale as Nike, we analyzed it recently, as Hershey, we analyzed recently. This type of companies which grow year after year for many years, for the last like nearly couple decades maybe, okay, non-stop. So which is pretty good. But now we're going to look at their price, okay, and we can see that based on their analysis, they get only 39 points. Okay, it means that it's not ideal, it's strong, it's high range, but it's not ideal. And why it is important to know. If you remember if we go back to the first part of our like meeting, to this, when we analyze this indexes, we can expect that the stock might go down. And like in general, index will go down, stock will go down, and it might represent us an opportunity to purchase the stock when it goes on a higher like scoring here system. Because for that, we need just to increase certain parameters. And if you analyze the spreadsheet, you will see that the growth, the value line prediction on the growth, price growth, at the moment is 15. And they give 4 points if it is above 15, and if it is kind of 15 or below, they give only 1. So we actually lost 3 points on that because we are exactly 15. If it was 15.1, we will get 4 points, and that would be actually here like 40 or something. So which is pretty good, right? So that's why you have to take it into consideration. Okay, but when you analyze the areas, ranges, where we buy, where we sell, where we hold, we can see that that's the area we can see the company buying range. So between 73 and 96, at the moment is 81. So it's in between, exactly. We hold this stock based on fundamental analysis between 96 and 119, nearly 20. And then whatever is above, we consider to sell. Okay, that's type of consideration. And we based our these ranges on the multiples which this company has historically. And like if we look at the highest PE ratio, average PE ratio for the last 5-6 years, okay, it was 21.85, so it's nearly 22, and the lowest was 16. So it means that when in the future we can expect that sometimes company will like the shares will be traded at multiples of 22, and sometimes will be at multiples of 16, or maybe even below here and above here. And at the moment is 18. We looked at this. Okay, so it means that at the moment it's just a bit higher than average. And of course, if it drops to 16, that would be the perfect. And for that, it has to go about 10% down. So, and if we look at current price 81, so it means that if it goes to 72, $73, that would be kind of our perfect time to buy it. And that's what we can see here. Okay, so $73. Another thing which I pay attention is book value. I mentioned it, it's $27 book value. But if you look at tangible book value, it's only $4. So the rest of it, it's intangible book value. Now, when the company gets like liquidated, get bankrupt, we're going to get whatever they can sell. Okay, and usually they cannot sell book value, or I mean, they cannot sell goodwill, and they cannot sell a lot of intangible assets. Some intangible assets they can sell, some can't. But that's kind of a risky situation because the company is $81 in price and tangible book value is only $4. So it means they have quite a lot of intangible goodwill within here. Okay, so it has to be kind of a red flag for us. Okay, be careful. But from other point of view, this company is so strong, like from quality, that I don't see that it's going to get bankrupt within the next, I don't know, 10 years, maybe something like that. Okay, at least if something major doesn't happen. Okay, pretty strong quality company, like average level of debt, constant profitability, etc., etc. Okay. What I wanted to show you about the reason, maybe before I show you those a lot of numbers, I wanted to ask you the question: why do you think the share price dropped within last year from $91 to $73? I'll get a drink while you're answering it, but please think about it and put your own suggestions. Why did it happen? Okay, no ideas? Okay, again, it's my only suggestions, but let's have a look. I always look not only at value line reports when I analyze company deeply, I always look at the fundamental analysis, like the balance sheet, income statement, cash flow statement, and not only annual, but also quarterly. Okay, and let's have a look. That's what I see. Total revenue. So what can we see here? It is growing. This drop in 2011, we could see it, right? So on value line as well. But after that, we can see revenue is growing quite nicely. Okay, that's good. Now, then we see gross profit. We're interested in the last couple of years. So what we can see with the gross profit? 21 billion and 119 million. Here, 400 million more. Here, nearly 5 billion more. Here as well, what? 3 billion more, 2.9 billion more, right? Profit. So gross profit is growing while this shares drop. But when we look at operating income, operating income is still growing. Okay, we can see it. But when we look at net income, and this is number which is shown to majority of investors. When you hear the report of the company, they talk quite often about net income or income per share. And we can see that despite the gross profit was higher, operating income was higher, the net income dropped. It was 5.3 billion in 2015, and it became 5.1 billion in 2016. I have all these questions. Why did it happen? Where did they lose their money? And we can see that 1.1 billion here, usually it's 42 million, and here 1.1 billion. Interest and non-operational expenses. I want to know what kind of expenses they have here. Is it temporarily one-time off expense? And what could it be? Like, if you have, guys, any ideas, what kind of expense could be here which can affect the price like that? And I'm going to show you it in the next slide. But if you learn how to analyze it and understand, it actually helps you to identify the companies with the best buy. Okay, so do you have any ideas what kind of expenses could be here? No, no, no. Marketing, it's all operation expenses. That would be investment activities, Alexei. All right, so won't hide it anymore. That's what it's goodwill and intangible assets. So look what happened. In 2014, they had only $2.3 billion in goodwill. And that's what we saw. Remember when the amount of shares increased? They purchased the company and they purchased nearly 14 billion of dollars of goodwill. And also they purchased nearly like 11 billion in intangible assets. And what they started to do, they started writing them off. So these are assets which not generating any income for you. It's like when you have a plane and this plane delivers something, it generates a profit. These assets, they don't generate anything for you. They're just there, like goodwill. It's whatever you overpaid for another company when you purchased it. So it's just on a balance sheet. And company, what they did, they wrote, just write it off. They say, okay, we just take it off. They have to write it off the loss or reducing their profit. So, and if we calculate here how much, so they wrote it off. So it was 16.3 billion, and here 15.5. So it means 800 million in goodwill they wrote off. And when we look at intangible assets, it was 12.3 billion, and now it's 10.3 billion. So about 2 billion. $2.8 billion in assets. And we can see, and that was exactly this non-operational expenses, because that comes as an expense. Okay, and that's where it comes this number. Okay, and probably they had some profit or whatever interest, but that we can understand. If we add now this number back, the profit will be higher than last year. So majority of investors who look at the stock market, they see only last number and they start selling their shares because they say, oh my goodness, look at this company. They start reducing their profitability, right? And they sell it off. But if you think about it, the revenue grows, like total operating income grows, and this part will be growing if they didn't write off their goodwill. Now the question is for you, is it a good thing to do or a bad thing to do? What do you think? Did you do a right thing to write off those intangible assets or not? What's your opinion? Stock went down. Yeah, Alexei, I got it. Now, and here it's interesting because Alexei is correct, but only from one side. When you look at the different companies in different areas, you will see that some companies, they carry their goodwill for years, and don't reduce them at all. They don't do that. And the reason is that managers, they don't want to affect the stock price, because very often their bonuses depends on the shown profit. So if they show the growth, profitability growth, they can tell you, okay, we get our bonus. If they don't show their profit growth, they don't get their bonuses. And because they are not shareholders, they don't care about if they have this huge like asset which is not generating any profit at all. They don't care. We looked at this company that owners, they have 20%, practically 20%, 20 billion 21% of investment in this particular company is the shareholders, which is pretty good. So that's why they're writing off these shares. And if you're owner of this business, it's a very good thing what they're writing it off. Yes, it reduces profit, like final profit, net profit, but from the business point of view, if you write off and show it as a loss or as an expense, what happens with your taxes? Imagine if they wrote off $2 billion of these assets, it's like loss, $2 billion in loss on that particular sale of this particular asset. It means that they save, if in tax level is 30%, it means that they saved about what? $400 million in taxes. Is it a good thing for you as a shareholder? It means that this $400 million is going to go into your pocket, right, as a shareholder. So these guys, they think differently from other managers because they are owners in here. And here that you can see tangible book value. It was 1.9 billion before, or $1.9 per share before, and this year $3.7. So your assets, your equity in each share increased 2 times because they did it. Okay, so it is a good thing when companies writing down. Now, if I saw the situation that they wrote off all their goodwill and now it would be zero, it will be a perfect opportunity for me to purchase the stock. I'll explain you why. Because the net profit dropped down, investor or traders sold off their stock. If I purchase the stock on this sell-off, the next month or next quarter or next year, they're going to show the profit already without this goodwill affection. And it means the jump for the profit would be much higher than before because it represents 2 years of growth. And the share price usually at that particular moment start growing very, very fast. So it grows faster than before and grows higher than before because people see, oh, look at this fantastic growth, okay, which company has. Now, in this particular situation, I wouldn't do like that. And the reason for that they have quite a lot of goodwill still left, $15 billion. So if they keep writing off for $2 billion of goodwill, it might take them another 7 years to do that. So, and those traders and investors who don't care to look at this, they will still see that the profit of the company is not growing, net profit. Even operational profit and sales level will increase, but maybe they will affect the net profit by writing off goodwill. So that's why, and we cannot know that because we're not directors. We don't know how they're going to do it. It's their own decision how they're going to write off goodwill. But based on what the fact that they had it pretty low before means that they might want to bring it down as well. And especially if they are buying a new company, they will buy certain goodwill again. So, and they might start writing it off in the future as well. So you have to be aware of that. Okay, was it clear, guys? If you're fine with that, but put plus, if not, put minus and write down the question. Okay, perfect.